Welcome to the Mortgage Broker Podcast, where we explore everything related to mortgages and the home buying process. If you're a first-time buyer or a seasoned investor, this podcast is for you. I'm your host, Vanessa, the Mortgage Broker. So, let's get to it. Okay, thanks for joining me today. I have Frankie Martin with me, and I will let her tell you who she is.
Hi, I'm Frankie. I am co-owner of Audacity Management. We're a digital transformation company, and I'm here today with Vanessa just to chat about mortgages, get some more layman's terms because I don't have that much knowledge on mortgages. And yeah, I'm excited to chat.
I'm excited to tell you all that I know. One thing that I wanted to address is that there's been a lot of changes in the market. So we've just, recently heard about Silicon Valley Bank, and there's a lot of disruption in the banking system in the US. And then there was a report that just came out the other day about foreign buying again.
Okay.
And how many immigrants are going to be coming to Canada or in Canada actually at this point in time. And it's all just kind of outside noise. There's always going to be things that influence a decision when it comes to a mortgage. And the biggest thing that I talk to my clients about, forget about what's happening with Silicon Valley Bank. Forget about what's happening with the Bank of Canada right now.
Gotcha.
And I've said this before in one of my other sessions, is that, you date the rate, you marry the mortgage.
Mm-hmm.
And so what it really comes down to is, are you ready in the here and now? Because there's going to be outside influences throughout the whole life of your mortgage.
Right.
So is it now? Are we ready now
Mm-hmm.
to make those changes?
Mm-hmm.
Whether it be restructuring. I mean, I took a client through the process a couple weeks ago, and I was able to free up $2,300 in cash flow a month.
Wow.
They're actually at a higher rate than what their mortgage was previously.
Mm-hmm.
And not only the higher rate, but now we've increased the size of the mortgage.
Right.
So when I first was presenting it to them, it's like, oh no, like we've been really trying to like pay down that mortgage. And I said, I get that.
Mm-hmm.
The problem is, what we're having right now is that you're focusing so much on paying down that mortgage,
Mm-hmm.
that you're allowing other things to creep up in the meantime. So credit cards,
Yep.
lines of credit,
Yep.
car loans, right?
Mm-hmm.
So overall, yes, your mortgage rate is higher, and in this case, they actually did have to pay a penalty as well. But because they were so focused on paying down this mortgage,
Mm-hmm.
they were using other means of financing to get by.
Gotcha.
Right? And so that's not gonna help you in the long run.
Right.
Because then, okay, sure, you paid off your mortgage, but now you've got
X amount of
how
debt.
much more debt at the end of your mortgage, plus at a much higher rate.
Right.
So if I'm able to restructure that mortgage now,
Mm-hmm.
and take care of that debt now, it's giving them that cash flow.
Right.
It's getting rid of that high interest debt.
Mm-hmm.
It's putting aside, a rainy day fund, as we like to call it. But also, and this is something that I've spoken about before, it's not always about paying down the debts. It's also about still trying to increase your savings, because one day
Right.
you're going to want to retire.
So
and what
even
does that
though-
look like?
Even though it seems scary in the moment to take the higher rate and the penalty, actually the math works out in the long term that extra $2,300 a month is going to save them in the long run.
Well, it's going to save them because now they're not paying that extra $2,300 towards debt.
Right.
And maybe it's not $2,300 that they're able to put towards savings, but even if they put half of that,
Yep.
a month into their savings, that's $12,000 a year.
Yep.
Let the accumulated interest do its work over time.
Yep.
If you do that year over year, you're much further ahead
Mm-hmm.
than if you were so focused on paying down a mortgage.
And I know you have obviously many different types of clients, so not assuming anything about that client in particular.
Yep.
for some people, $2,300 a month is rent, or like just a whole, I guess rent and mortgages don't align, but you know what I mean? Like,
Yeah.
that is literally someone's paycheck sometimes.
And that's the reality of it.
Yeah.
And that's why if the payments are that much going towards the mortgage, and then you've got outside debt on top of that, and you're only making your minimum payments because you don't have the allowance of additional funds to pay off the mortgage and pay off these high interest accounts.
Right.
And if you did, your situation wouldn't look like that.
Right. And obviously, without going too much into detail, how do you find $2,300 a month? Like, where do you even begin?
The magic
Because you can find it for me if you'd like.
Honestly, it always goes back to numbers don't lie, and it's just strategizing and starting the plan now, to keep those numbers moving in a positive trajectory going forward. So the 2,100. So what in this case, I had taken about $106,000 worth of debt outside of the mortgage.
Wow.
Okay, so it was a car loan, a $50,000 car loan. I know some of these numbers seem kind of crazy, but the reality is there's a lot of families out there. You know, both partners are working, they've got kids, you need vehicles to get kids around. So that's the reality of most situations right now.
Right.
So I had taken $106,000 that was currently owing an outside debt, and just into car loans alone was $1,200 a month.
Wow.
So finding the additional savings on top of that wasn't exactly difficult, because that was a huge payment that they were putting towards a car payment, as opposed to using those funds a little bit more strategically.
This might seem stupid,
Yeah.
but how all of a sudden are they allowed to not put the $1,200 towards the car? Like, how?
We pay it out. So
via...
so what I do is I increase the total amount of the mortgage, so as long as there's equity available in the home.
Gotcha.
Because they've been so focused on paying down that mortgage, there was equity in the home that I was able to restructure the actual mortgage, add that $106,000 to the mortgage,
Gotcha.
paying off those other debts entirely and freeing up that money.
Interesting.
Yeah.
See, like, I didn't even know you could do that if you wanted to. So just knowing that all of a sudden you have, like, your 3 sources of debt is turning into one, much more manageable.
Well, and this goes back to working with someone that you trust, being able to be vulnerable about the situation that you're in, because oftentimes, and it's unfortunate, sometimes clients come to you too late, and it's like, if you had to come to me 6 months ago, you know.
What does too late mean?
Too late means they've been embarrassed to say anything because they're carrying this debt, and now it's become so difficult for them to even make the payments. So now there's derogatory items on their credit bureau, and so where I could have kept them, you know, maybe with a traditional lender, an A lender on the prime side, I'm now having to move them into more of an alternative financing solution. My main goal is to always bring them back to an A or a prime, but you know, that's what I mean by too late. You've kind of, because you didn't say anything, I wasn't able to restructure it 6 months ago. Now we've got late payments, and now we've got to look at alternative solutions.
So regardless, basically, of whether you're actually, you know, I mean, most people are aiming to own a home, but regardless, having a conversation with a mortgage broker like you would mean that even if that mortgage isn't going to happen immediately, there could be a plan at least, so that the finances you currently have may not look that way in 6 months, and that's when the mortgage would be able to be applied for. Which, in general, I mean, if I had that information and I was in that position, one, it would make me gain trust in you, but it would also make me a lot less overwhelmed, being like, no, I do have options.
Well, and it's helpful too, like, I come from a background where I worked for a private wealth company. So, you know, I was able to gain the experience of how a full financial plan works. Not like you go and talk to this person and they're
Mhm.
going to give you one answer, and then you're going to go talk to another person that does something completely different.
Right.
So it's more of a cohesive overall plan that you're looking at.
Mhm.
And because I've benefited from going through those exercises with financial planners that I still work with and talk to
Mhm.
this day, because I know that information, I'm able to easily pick up on what is your situation right now,
Right.
and if we can't get to home ownership today,
Mhm.
what are we going to do to put a plan together
Right.
in order to get you to that goal?
Right.
When I'm looking at the whole plan,
Mhm.
right, what does the situation look like now? And how can we get you to that home ownership goal if that's really what you're after? A good friend of mine, Erin McIntyre, she had said on one of our last sessions about how don't go out and buy the car before you get the house,
Mhm.
right? And it's a piece of information that unfortunately not a lot of people know, right? So if you go out and you buy a new car, now you've got a monthly payment.
Mhm.
Now your mortgage broker or the person who you're working with is now having to add in an additional payment with the additional debt that you're looking for in a mortgage.
And what does that do? Like what?
Well, it could actually inhibit your approval by quite a lot.
Oh.
So, just for a general sense, if you were looking at purchasing a home for $400,000 and your payments were $400 a month, that's automatically going to drop your payments, or it's going to drop the amount that you could actually look for a home by about 40 to 50 grand.
Oh wow.
Right? And that's 40 to 50 grand that you can't just make up somewhere, right?
I wish.
So it's a lot easier to apply for the mortgage first,
Mhm.
wait for the house to close,
Yep.
and then go and apply for the car loan.
Yep. Or I mean, and even what you were saying about the being able to kind of tag the car loan into the mortgage, etc. Like having those options after the fact is one thing, but blocking yourself from ever having those options is another, right?
Right. Also, we have access to what is considered a monoline lender. So the biggest being MCAP, RMG, First National. They are specifically in mortgages, so they don't do anything except for that line of business. But with an A mortgage comes the lower rates that you would see on like ratesupermarket.ca. Be careful with that as well, by the way, just because what's on there is like a very specific type of product
Gotcha.
offering, and when people go on there they go, oh well, they're offering 4.64. Yeah, but that's if it's a purchase, if it's closing within 30 days, if it's like there's
Mhm.
so many parameters that you have to fall into, but I won't go too offline there. So having access to that as well as credit unions,
Okay.
so that would give you the benefit of those lower rates, but then also lower fees.
Okay.
So the fees are directly, they would be charged by a title company, so like First Canadian Title, FNF, or a lawyer if it's a purchase that's closing. Okay. So that would be your A lender.
Mhm.
If you've kept up on your credit, your score's over 640, 680 is actually really the minimum. There'd have to be a good story behind why it's less than 680.
Okay.
But 640 you can kind of slide in there, and everything is above board.
Mhm.
Then we'd be looking at an A lender for you. If there is a little bit of questioning, or if there's any derogatory items, one thing that I talk about all the time is make sure you're making your payments on your credit cards, because even if it's only 15 days late, that's 15 days late. That's being recorded to a credit or to your credit score. and greatly impacts your overall score. Okay, so if those are the things that are kind of happening behind the scenes, or maybe the income just isn't enough, or we're not able to qualify it traditionally, we would use what's called extended ratios, and that's where you would fall into more of a B lender or alternative.
Okay.
So those monoline lenders actually that I had just mentioned, they actually, most of them have an A side and a B side.
Oh.
So if I can't get it approved on the A side, I can say, okay, you know what, like, let's take a look if we can still use the same lender. Always keeping in mind what are the fees, what are the terms, what is going to benefit the client the most. And so I was going to say something earlier and I kind of stopped myself, but I think I found a different way of wording it, which is, you know, having access to the larger banks. Of course, that's very, very helpful. The difference is that I have a fiduciary responsibility to my clients. Okay, so I have access to all of these different lenders, and it's up to me as a broker to be informed and use the knowledge and the experience that I've gained over time in being in the mortgage industry for 15 years and pairing up the best product with my client.
Right.
If a client walks into a banking institution that they've been dealing with for years, they have a fiduciary responsibility to the bank.
Right.
That's who's paying their paycheck.
Right.
Where I am able to kind of source from a number of different resources and really dive deep using, you know, that financial experience or financial planning experience that I've been able to sit alongside for so long, and just making sure that the product really works for the client.
Right. So what you're saying is basically, if everything went right or if everything went wrong, no matter what the scenario, ultimately it's your responsibility as the broker to ensure that everything is done properly and above board. Whereas if you were to go to a bank, there's every chance that if something went wrong, you'd kind of be tossed around from department to department to get it resolved, rather than that advisor that helped you being kind of your champion almost.
Yeah, essentially.
Interesting.
Like once a client decides that they want to work with me and we go through the process and the mortgage is approved, I'm very tight with the process that I have. So it's not just throughout the time of the mortgage, it's following up with them.
Right.
Following up with clients is massive, and it gives them that extra sense of security that, you know, they do care. And bottom line, I care about my clients. Right. So reaching out to them, making sure, you know, after the first payment, did it come out right? Did it come out on the right day? How's everything going? You know, just touch base. But even further from there, every year my clients get a survey. Because most times clients change their mortgage or change the structure of what they're doing, whether it's they're purchasing, they've got a kid going off to school, they need to buy a new vehicle. There's a number of reasons that their situation changes. And so by touching base with them year by year, you know, is there any debt that you can't pay off in the next 6 months? Do you have someone going off to school? Are you finding your payments tight right now? Those are all things that give me a little bit of insight when they're answering those questions. Do we need to take a look at this? Well, are there changes that need to be made?
Absolutely. I mean, I don't necessarily can't speak to some of the larger assets, but even credit card or line of credit, never been checked up on, never making sure that even what that limit was that I was approved for X amount of years ago is still working for me, none of that. So even just knowing that you're open to having feedback consistently is actually quite nice to hear.
Yeah, well, and this is going to sound a little bit funny, but a lot of times my clients become my friends. So even if they're not getting those surveys, I've probably seen them out at a restaurant, or I've talked to them, or they've added me on social media, and you know, just kind of following what's going on in their life. They're kind of following what's going on in mine, but it's that personal touch, you know, and they're never really afraid to reach out and say, hey, like, you know, I've given that comfort right from day one. You can be vulnerable with me about your finances. And that can stay completely separate from, I like you, you're a good person, I think I'm a good person, and we can be friends after this.
Right.
So
I think that speaks to your ability to create a good network as well, right? So, just could you explain what is different about B lending from A lending?
Yeah, so it still goes through the same process. Like, I would still, take an application, I would still send it to a lender for an underwriter to review it. The difference is that the rates are going to be a little bit higher. They're probably shorter terms. The shorter terms are actually a benefit to the client because I'm always trying to move them back into that A or prime lending space. I don't want their term to be more than 1 to 2 years because while I'm going through the process with them with the application on the B side, I'm also going through some credit guidance with them and trying to, this is where we have to go right now. This is what I need you to do for the next year.
So that hopefully after that year they're able to move up into the
A. So I actually had a client, unfortunately they were in a bit of a situation. I had to put them in with a B lender in October, I think. October, November. They're going to be closing in a week from now because I've already been able to move them back over to the A side because they listen to me.
And so with that, their rate and their fees are dropping?
Yep.
Interesting.
Well, no fees. So they'll have to pay a penalty.
For leaving the mortgage
leaving the mortgage that they did.
Interesting.
But because there was a plan, I didn't put them into a fixed rate mortgage where they were going to have to pay an interest rate differential. I put them into a mortgage where I knew they would have the least amount of a penalty to pay if we were getting them out. So knowing that information or having that plan in place, they're now leaving a rate that is over 8%. They're only going to pay a 3-month interest penalty. And now we're moving them back over to the A side.
Interesting. And usually,
and the rate's going to drop down to 5% from 8%. So it's quite substantial. Yeah.
That could really actually change someone's cash flow each month quite substantially.
And it does. Yeah. And because I have a lot of relationships with financial advisors, I don't claim to be the expert. I let people do what they're good at as long as they let me do what I'm good at. And so making sure that if they don't already have a financial advisor, the network of people that I work with, it's not just me that you're getting. Yeah. You're getting
a whole squad.
Inventory items. One thing that has come up actually quite a bit with a few of my clients lately is not only just missed payments or non-payments, because most people are really good about making sure they're at least making a minimum payment. The biggest surprise as of late is that they're so overextended on their credit items. So even if they've been making their payments, that overextension on those credit items, so if your balance is more than I would say more than 50 to 60% of what you're allowed to use, that's going to drive that credit score too.
Interesting. So even though they give you the full amount, you shouldn't actually let the balance become over 50, 60%.
Right. It's not really a rule about, it's once it goes over that 50 to 60%, that's when it starts to impact the credit.
Okay.
So overall, there's 5 C's of credit. So there's collateral, there's credit, there's capacity. Oh geez, I'm going back to like my
you can do it,
back to my original days of lending.
You got one more?
One more? 2. I can't remember. There's actually 7 and I'm only getting to 4.
Well, at least you're over 50%, I guess.
Fine.
Okay, so we were talking about derogatory items.
Yes.
Where were you going with the 5 C's of credit?
Well, the 5 C's of credit is like each component affects your credit score.
Understood. Okay.
So capacity would be how much you're actually using of that credit. Would be one of the items. The credit C would be, are you paying on time? Are there late payments? Are there non-payments?
Mm-hmm.
So some of the C's of credit actually have a greater impact of that full pie, but they all do have a spot in there that it could affect your credit.
Interesting. Yeah. And so that's all basically explaining what a derogatory item is and how it's going to impact your mortgage rate, basically.
Yeah.
Interesting. And how would you, I need you to introduce it, but how would you describe variable versus fixed mortgages?
Yeah, so I have this conversation quite a lot with clients or clients that I'm bringing on. And they're kind of just, in a lot of cases, just presented variable versus fixed, but it weren't actually explained the difference, right? So the misconception is that variable and fixed, if one goes up, the other is going to. That's not actually the case. So the variable rate is actually tied to the Bank Rate of Canada. Okay. So it is a completely separate entity in how it's being measured than a fixed rate that is driven by the bond yield.
What's a bond yield?
Like your Canadian savings bonds.
Gotcha. Okay.
So two completely separate entities, which is why we're actually seeing lower fixed rates right now than we are the variable, because they're not aligned. They're two separate entities. So the variable being driven by the Bank Rate of Canada, if the prime rate right now at 6.7, so if you're getting prime minus 1, you're sitting at 5.7, right? The fixed rates right now, they've actually dropped quite a bit, especially since there's been some nonsense going on in the States with the banking system. Maybe I shouldn't say nonsense, but it's greatly impacting, right? And so because the bonds have been dropping, the fixed rates have actually been lower than what the variable is. Historically over time, and even though that the variable is higher right now, historically in the mortgage industry, it has always outperformed the fixed rates. The difference is, can you handle the peaks and valleys of what a variable may throw at you?
Gotcha. So if you're going into a variable, it's basically saying that it will fluctuate as the rate with the Bank of Canada fluctuates.
Yep.
So are you able to handle a potential higher payment some months?
Well, an increase in 2022 of 4%.
Right.
Right? Like we weren't...
Slightly unprecedented.
Right.
But
Yes.
Yeah.
But is that going to hold forever?
Hopefully not.
Probably not. Right?
But it is still a risk going into a variable mortgage that payment may fluctuate from month to month, whereas a fixed, it wouldn't.
Right. And for those of my clients right now that are in a variable, I'm also in a variable for myself. And, it does get tighter as those payments increase. But over time, I think that variable is going to come back down. I think that that's something that we're going to see this year.
Well, I heard... I was speaking with someone the other day and they had said that they were reading an article by an economist saying that the interest rates for mortgages specifically, I don't know how that works, but they should be coming down in September, October time. How does somebody come to that type of assumption or theory?
Well, this is something that they do all day, every day,
Gotcha.
Right? That's why we leave it to the economists and we leave it to the analysts.
Gotcha.
I know lots of people think that they can use their Google instead, and that's fine. But we leave it to the people that, this is their craft. This is what they study. And this is, and there's different factors that go into it. So there's different indicators that they're looking for. The biggest one last year being inflation. And so one thing, and I don't think that it was explained clearly enough to, Canadians as a whole. But the reason that we saw inflation or why the rates went up as high as they did is because there's 3 factors that go into the makeup of deciding what that rate's going to be. And so supply and demand is one of them. The current rates is another, inflation. And then the actual rate itself.
Gotcha.
And so they can't really control supply and demand.
Right.
But they needed to do something about inflation. So they only had one avenue left out of the three.
Right.
The rates had to go up to bring the purchasing down.
And for
to build up the supply.
Right.
For the demand.
Gotcha. So for anyone that's kind of unaware, I guess, how does hiring interest rates bring prices down?
Well, what it's supposed to do and what it's done are two different things. I mean,
Gotcha.
I have my own take on, what's kind of happened. And again, I'm going to leave it to the economists. And I'm going to leave it to the analysts because that is not my craft. But the idea was if the rates are higher, not just your mortgage is going to increase, but car loans, credit cards, anything that's driven by that prime rate of Canada is going to increase, which is going to make it more difficult to spend money on items.
Right.
And because supply and demand is such an issue, we didn't have enough supply for the demand. So if people weren't purchasing, they could build up that supply to then to meet the demands.
Interesting. Okay.
It just was very unfortunate that the timing of coming off of a pandemic, right? There's a number of small business owners, not even small business owners, big business owners, that were greatly impacted by COVID. And then we've got this surge of inflation, and they're being impacted again because people are less likely to go out to dinner, to spend, on services for women. I know for myself, if money is a little tighter, maybe I'm not getting my nails done. Maybe I'm not going for a massage.
Right.
But that's only now impacting those in the service industry.
Right.
So hopefully, inflation has been coming down, and that's what they've really been trying to drive. So there's some that are saying we could see a 0.75% drop by July. There's some that are saying we're going to see it hold steady until the end of 2023.
Right.
And then there's some that are saying we're not actually going to see any movement until 2024. Which do I believe? I don't believe any of them.
Right.
Until it's happening.
It happens when it happens.
Right?
Because I guess you can't change the way you perform your duties based on people's predictions.
No.
Necessarily.
Well, we do rely on, the information that we're receiving. Because, with the variable rate, I'm talking to clients last year and it's okay, Bank of Canada's made their announcement. Everything's kind of status quo. We might see a 1% increase by the end of the year. Okay. My clients can handle that because they're still going to be around 2.5% to 3%.
Right.
That's not what we saw.
Right.
We saw 4 points. So that's why I'm saying, which do I believe? I'm kind of, at the mercy now, being like,
whichever way it swings, I swing too.
Whichever way it goes, right?
So just as a, I guess, general, I know it will differ from client to client, but in general, what is kind of the rule of thumb if we're not in such high inflation, we're not coming out of a pandemic when it comes to variable and fixed? Because
which would I recommend?
Well, that, but I mean, just again, not having much knowledge about mortgages and talking to people about it. Normally they'll just shove variable down your throat, but to me, if fixed is an option, it's an option for a reason. So I know it is, again, client specific, but what's, I guess, your rule of thumb when it comes to mortgages outside of this type of interest rate land?
It's knowing your client. It's taking the time to actually ask the bigger questions. And that's not something that's done with every bank, every agent even, again, I think that comes back to the financial planning, being in that industry for as long as I was in mortgages. but I was able to sit down and actually go through financial plans with certified financial planners.
Right.
How are you seeing this, and how am I seeing it, and how can we kind of bring it together?
Right.
And so that has kind of given me a little bit more of an advantage to be able to ask those same questions up front that maybe a financial advisor would ask, without stepping on any toes,
Right.
of course, but digging into the bigger picture.
Yeah.
Because I know what the numbers say to me, but I don't know if your kid's in 3 sports.
Right.
I don't know if you want to take a trip every year for 10 grand.
Right.
Like there's so much more that goes into it than just what's your total debt service ratio.
Gotcha.
Right?
What would you, I guess, say to someone, let's make it a bit more general.
Okay.
Someone that's not trying to take a $10,000 trip, no kids, maybe first time home buyer, second maybe. It's at that point, they have maybe a $5,000-$10,000 credit card, $5,000-$10,000 credit line. They're decent at paying it. It's like the variable we know can fluctuate, but does that mean that, again, outside of right now, that usually that rate would be lower, so that's why people choose variable, but then forget at that moment that it can go up later? Or is it that fixed rate is a bigger number, but because it's a bigger number at that moment, they choose not to take it?
So
even though long term it
yeah,
could be better.
So again, like it still goes back to knowing your client. So when I'm having those conversations with them, it's, are you okay if the payment was to go up $120 a month? The numbers in front of me say that it can, but I don't know where else you're doing your spending outside of what the credit's telling me.
Gotcha.
Right? Because there's a lot of clients actually that, wanted to go variable, but I could tell that they were wanting to choose variable because they thought it was the cheaper option
at the time,
and it was what everybody else was doing.
Right.
And they've taken the fixed option because I'm like, you won't sleep at night. If you take this variable option, you won't sleep at night.
Right. It becomes such more stress than anything else.
Right. So oftentimes with first-time home buyers, just because it is their first purchase, they're putting pretty much everything they have into it. A lot of times we do tend to go more the fixed, because here's your payment, here's what it is. You're good.
Good.
Right?
Yep.
We know that you can afford it. There's no fluctuating. And if we do have to revisit the mortgage before the end of the 5-year term, there's always options, right? The other thing about the variable, and I'm not sure that enough people know this, is if you do take a variable, and I did this with quite a bit of my clients. I'd actually considered it a couple of times for myself, but went, Vanessa, be what you preach,
Right.
But because it gets concerning when that rate is climbing, right? So with the variable, if you were to take it and the rates do start to get to a point where you're a little uncomfortable and you can't really take much more of a hit, we can always look at locking it into a fixed term with no penalties, no fees.
At a later date.
At a later date. So the caveat there is, if you had 4 years left on your mortgage in that variable, you would need to take a 4-year fixed or longer.
Gotcha.
So you can't go, well, I'm going to take a 1 or 2 year fixed. Right? But there is the option there to readjust if you need to.
Oh, that's good to know.
Yeah. And it doesn't cost anything to do it.
Oh, good.
Is the biggest thing.
Right, absolutely.
Yeah. It's funny, I was talking to a colleague of mine. I used to work with her years ago. She's approaching retirement, and I'm just kind of telling her things about the difference of what I thought the broker space was to what it actually is.
Right.
And she goes, well, like, you guys just charge so many fees. And I said, no, we don't. Like, as long as the client fits in that same box for, like, a prime mortgage or an A-lended mortgage through, traditional lending, we don't charge fees ourselves.
Right. It would be the lender.
It would be the lender who actually pays us. But I think that that's the narrative that, some of the bigger institutions are using. Well, you don't want to go to a broker because they're going to charge you fees. It doesn't cost anything more to work with me.
Right.
If anything, you're just getting more options.
Right.
When you're working with me.
Oh, absolutely.
Right? Now, there are times that there are fees, and there would be a fee to work with a broker, but those would be discussed up front, and it'd be very specific to the situation. So if I can't get something approved traditionally on that A or prime side, the B side or the alternative space, there are fees.
Right.
But those are outlined up front. It's not anything that you wouldn't find anywhere else.
Right.
And you're not being approved in a traditional bank.
Well, and I guess at that point, those fees are not necessarily a risk, but the risk you are taking to gain the benefit of being approved for that mortgage in the B side, right? So it's kind of a give and take situation when the math is done correctly.
But it was just funny to me, somebody who's been in the mortgage industry, worked for a financial institution her whole life, not her whole life, but her whole working career, thought that brokers take fees.
Yep.
It's like, oh, well, now it makes sense why everybody thinks that I cost so much money. But truthfully, it doesn't cost anything more to work with me. You just get more options.
Right. And if she did charge the fees, she'd be able to get her nails done when her variable mortgage goes down.
Oh, maybe no.
Okay. I feel like that is